So another topic we will go through is devoted to the credit risk management, which is actually, if we talk about the banking system, about the banks, for example, there is such a definition as risk profile of the company, risk profile of the bank. So therefore, credit risk takes for about 70% of the risk profile, while for example, market risk takes for about 10% of the risk profile or less, or even less. And credit risk takes for about 70% or more, or even more. So therefore, it is very, very important in terms of the risk management. Let's start from the first topic, which is credit risk components, PD, LGD, EAD. So PD is probability of default, LGD loss given default, EAD exposure default. So and credit risk for sure, it's a key factor in lending, and a key factor, almost a key factor in the overall banking activity, for example. But nevertheless, credit risk is may relate, for example, for the other companies, for example, trading companies, consulting companies, and therefore any company making deals, for example, with the different counterparties. So there is a part of the credit risk and market risk, which is called counterparty risk. But it is more market risk when we consider, for example, the counterparty for the operations on the financial markets, and it is more about credit risk when we consider the counterparty, for example, for the ordinary operations, for the so-called documentary operations and loan issues. So therefore, let us consider credit risk examples and improper management. Credit risk overall is essentially the probability that the borrower won't repay a loan as agreed. And this might seem simple, yeah, but it has far-reaching consequences for financial institutions, actually. So let us consider the real-world examples of credit risk events. For example, they might be borrower being more than 90 days late on payments. So the payments overdue. Why 90 days? It is a practical aspect. It is a practical figure. So that means that if a borrower doesn't pay for 90 days or more, then we call it usually a technical default of the borrower. So that means that we have to pay much more attention to this borrower, for example, in order to get our payments back, or even the notional loan back. So the next event may be a loan restructuring that results in a significant loss. So if a borrower applies for the loan restructuring, it usually means technical default as well. Having to write off a loan entirely, so this usually means legal default. So you generally you cannot write off a loan entirely without the legal decision. Yeah. So before that goes soft collection, hard collection, and then legal decision. See, NPL 90%, that means non-performing loans for not 90%, non-performing loans for 90 days. That is a very common measure of the quality of the loan portfolio. But I would like to stress your attention that NPL 90 does not mean the overdue or the volume of overdue. It means the volume of loans, those are overdue. The volume of loans, yeah, or the rest of the loans, those are overdue. It's not the overdue itself. So there is a difference. Having to write off a loan entirely, it's not possible usually without a legal decision, for example, of the court. And borrower declaring bankruptcy. So this is a legal issue as well. But there is a question, why should we care about this? Poor credit risk management can seriously hurt a bank's profitability. It can damage asset quality, for example, and in the other extreme cases, even lead to financial distress. For example, there are many examples of the banks struggle with these issues firsthand, and believe me, it's not pretty. So the next slide is about ECL, or expected credit loss. So, or simply expected loss, or expected loss due to credit. So let's break down this measure into the components. Why it is important to consider to go deeply into the expected credit loss? Because it is a common measure of the credit risk of the portfolio, actually, and it is usually based. It is usually used as a base for the provisions calculations, obligatory provision calculations of the bank, which is due to the regulatory requirements. So in general, ECL is calculated using three main factors. The first one is probability of default, or PD. Then goes loss given default, or LGD, and exposure default, or EAD. So we can think about this risk metrics as a risk triangle, actually, because each component is very crucial for understanding the overall risk picture. And the formula is simple. So as you can see, so it's just a multiplication PD by LGD by EAD. And but not let that simplicity fool you. Each of these components actually requires careful analysis and modeling. Let's look at each one of the metrics. First of all, PD, probability of default, is the likelihood of a borrower defaulting in the next 12 months. It's forward-looking usually, and meaning we are trying to predict future behavior of the customer or a borrower. Then goes LGD, which is a percentage we expect to lose if a default occurs. And this also needs to be forward-looking as well. And exposure default is usually our estimated exposure when a default happens. And this is, I would say, more of a present-day snapshot. So to sum up, understanding these components allows us to make more informed lending decisions, for example, and better manage our overall risk exposure. So the next slide is potential impact of credit risk on the bank's credit portfolio. So let's talk about that. First of all, credit risk directly affects asset quality, as you may understand. For example, high-risk loans can quickly turn into non-performing assets and or non-performing loans, NPL, dragging down the overall quality of the portfolio, for example. And another danger is excessive growth. So we can observe banks who get into the trouble by growing their loan book too quickly without proper risk controls. And it's like, for example, it's like driving a car too fast. So you might not notice the danger until it's too late. And then concentration risk is also a major concern here. Because, for example, imagine if you're a bank which had a large portion of its loans in a single industry that suddenly faces a downturn. So, there are many examples of the banks that had heavily exposure to the oil, for example, in gas sector, lending money to the exporters. When oil prices plummeted, for example, it was a very stressful time, especially in 2008. And lastly, we have the issue of hidden impaired loans. These are like icebergs. For example, what you can see above the surface might look manageable, but there could be a lot more trouble lurking beneath. So therefore, banks need robust systems to identify and address these issues early. The next one is, so the Bank of Russia and the Basel Committee both emphasize that the importance of the internal ratings-based approaches for calculating credit risk and capital requirements as well. And this isn't just a bureaucratic red tape, actually, because it's based on years of experience and research and into what makes banks stable and resilient. And at the heart of these models are borrower defaults. So they are usually like the DNA of credit risk. By studying them, we can build more accurate and predictable models. For example, there are many examples of the implementation of the internal ratings-based system in the banks. And for example, as to my experience, it is usually a challenging process, but the insights those might be gained might be invaluable. So, for example, you can uncover risk concentrations you hadn't been aware before, and you may be able to price your loans more accurately by doing this exercise. And the most common definition is a payment delay of more than 90 calendar days. So, which is an overdue or technical default. But it's not just about late payments. So as I said before, other indicators of default include loan write-offs, borrower bankruptcy, increased loan loss provisions, for example, loan restructuring. And in other words, these default indicators are signs that a borrower might not be able to repay their obligations. It's like checking the vital signs of a loan. So where we are looking for any symptoms of distress. And as for my experience, for example, early identification of these indicators can make a huge difference, actually. For example, when I worked for one of the large banks, we strongly improved its early warning system. And due to that, they were able to intervene much earlier in problematic loans, significantly reducing their overall losses as well. So, and for the probability of default, now let's dive into the key component of risk, the probability of default, or PD. It is really essential to estimate this value, this metric of how likely a borrower is to default within the next year, for example. And therefore, as you can see here on the slide, there are two main types of PD we can use. First one is point in time, or PIT, and the next one is through the cycle, or TTC. Actually, point in time probability of default, as you can see here, reflects the current economic conditions. It's like, in other words, it's like taking a snapshot of risk at a particular moment. And we can use this, for example, for things like pricing, short-term products, and stress testing. And through the cycle, probability of default, on the other hand, is usually based on the average long-term default level, and it is more stable over time, and it is used for price and long-term products, for example, creating provisions under IFRS, International Financial Reporting Standards, and calculating regulatory capital as well. But in practice, we often use a hybrid approach. As I said, for example, I can remember working on a project where we had a balance of the sensitivity of the point-in-time probability of default with the stability of through the cycle probability of default. It was challenging, actually, but it gave us a more nuanced view, I will say, on our risk profile. So we talked about the probability of default, about the components of the credit risk. Therefore, one of the main components of the credit risk is probability of default, which is being calculated by means of the scoring approach or scoring methodology. And let's talk about how we actually can calculate probability of default in practice. So for the new loan and for the new loan applications, we usually use application scorecards, so-called scorecards. And these scorecards, they assess clients' creditworthiness, which is maybe based on the information we have at the time of application. For example, in general, it's like doing a quick health check before giving someone a loan, for example. And once a customer has a loan with us, for example, we can use behavioral scorecards. This may look how the customer actually behaves. Do they make payments on time? How do they use their credits? Whether they give us a more dynamic view of the risk and so on. And for example, for the clients who are already delinquent, we use specific scorecards to assess probability of recovery, usually, which helps us to make decisions about collection strategies. And here on the graph, you can see the so-called decline cutoffs and approval cutoffs. What does it mean? Actually, we also use cutoff scores to automate decision making. And scores above the approval cut usually get automatic approval, while those below the decline cutoff, they usually are automatically rejected. That is a difference. Okay, the next component of the credit risk is loss given default, or LGD. It's a really crucial component of credit risk, and this tells us actually what percentage of our exposure we expect to lose if a default occurs. So this measures the state of the loan or the loan payments in the future. So at the time of default, not now, but at the time of the default, possible default in the future. So we look at LGD in three main ways, usually. First of all, long run or base LGD. And this is the average loss level over an economic cycle. Then goes downturn LGD, which estimates usually losses during economic downturns. For example, remember that default tend to cluster during bad times. And the next one is LGD and default. LGD in default, which looks like at expected losses for assets that are already at default. And each of these components serves a different purpose. For example, base LGD is used for general risk assessment and pricing, while downturn LGD is crucial for stress testing and capital calculations. And finally, in default LGD usually helps us manage our, for example, non-performing loan portfolio. That is a difference. So now let's take a look on how we actually model LGD. And this is where things get really interesting. For example, our LGD model considers different post-default scenarios. For example, the first one, debt write-off, then sale of the debt, then recovery through legal action, then, for example, borrower recuperation, where they get back on their feet. And for each scenario, we estimate usually both the probability of its occurring and the expected loss if it does not occur. And final LGD is weighted average of these scenarios. It's like predicting the weather. For example, we're looking at different possibilities and their likelihoods. And here we also calculate minimum and maximum LGD to understand our range of potential outcomes, which helps us in terms of the stress testing of our portfolio, and it helps us to set appropriate reserves as well. And the final component of exposure of expected loss or credit risk is generally exposure default, or EAD. It represents usually how much we expect to be owned at the time of default. Please pay your attention to that, not now, but in the moment in the future, as well as LGD. So at the time of default in the future. So exposure default can be tricky because it might be different from the current outstanding balance. For some products, for example, like credit lines, the exposure could increase as a borrower nears default. And here we typically see two patterns. First, one is fixed balance products. Here, the exposure usually decreases over time as the borrower makes payments. And the second one is variable exposure products. These are trickier, in fact. Why? Because the exposure here might increase if a borrower draws down more credit before defaulting, for example. And in general, modeling exposure default accurately is very crucial for managing our risk exposure. So when it comes to modeling exposure default for corporate loans, we usually need to consider different product types. For example, for fixed limit products like term loans, exposure default is relatively straightforward, and we can project the outstanding balance based on the repayment schedule. While variable limit products are more complex. For example, for funded products like overdrafts, we may need to estimate potential additional drawdowns before default. And for unfunded products like guarantees, for example, we estimate the likelihood of the guarantee being called. And here, the key is understanding utilization patterns. For example, in the bank where I had been working before, they noticed certain industries tended to max out their credit lines before defaulting. So it's a very usual process. And this insight, for example, led to more conservative exposure default estimates for those sectors. Yeah. And finally, for sure, accurate exposure default estimation is really crucial for example, setting appropriate credit limits and calculating potential losses. So let's finally look at exposure default modeling for retail loans. This is where we deal with large numbers or small loans. So statistical approaches are key. Real keys for this case. For example, for non-renewable products like personal loans or mortgages, exposure default may be relatively stable. Yeah, and it typically decreases over time as borrowers make payments, and here the main factor is a long term. And the other case is renewable products, like credits, for example, open loans or open credit lines or credit cards, for example. Why? Because the balance can go up or down unpredictably here. And due to that, we can see high exposure default volatility, which influences our credit risk estimation for sure. Here, what is the solution of the problem, actually? Here, we can use, or we have to use, behavioral information, which is really crucial here for accurate estimation of the credit risk. But in both cases, we can calculate exposure default as a percentage of the current debt, but the specific formulas differ based on utilization rates. And here we have to remember, actually, while these models can get complex, for example, the goal is simple: to accurately estimate our potential exposure if a borrower defaults. And this is really crucial in terms of the pricing, in terms of the limit allocation and capital allocation, and so on. So we have come to the first question of the lecture. Which of the following is not a component of the expected credit loss calculation or credit risk calculation? So please write down your answers into the chat. Yeah, it's very simple. Yeah, great, thank you. Okay, yeah, the fourth answer is right. Credit conversion factor is not the part of the expected credit loss. Yeah. Directly, why? Because according to the lecture, expected credit loss is calculated using just three main factors: probability of default, loss given default, and exposure default, as you can remember. And here, credit conversion factor is not mentioned as a component of the expected credit loss. But I would stress your attention that credit conversion factor may be treated in some cases as part of the credit loss calculation, but not in that case. So let's go on. The next topic will be credit scoring and rating systems. Okay, first of all, the base of any credit model is a model concept. So let us delve deeper into the modeling of the credit risk. Therefore, a model, what is a model? A model, in general, is a mathematical apparatus that describes a complex relationship in a relatively simple form. As we dive into the credit scoring and rating systems, let's start with the fundamental concept of a model. In essence, a model is our way of simplifying complex real-world relationships into a manageable mathematical form. You can think of it like creating a map, for example. Just as a map doesn't include any tree or pebble, therefore a model doesn't capture every nuance of reality. Instead, it focuses on the key elements that drive the relationship we're interested in. And therefore, every model has two crucial components. First of them is the target variable, and this is what we're trying to predict or estimate. In credit scoring in particular, this might be the probability of a borrower default, for example, if borrower is defaulted on the loan. And the factors or predictions are the other components of the credit risk model. And all of these inputs are being used to make our predictions in general, usually. And for a credit score, this could include things like income, age, or, for example, credit history. To give you a concrete example, let us imagine we are trying to predict a person's income, for example. Our model might look something like that. For example, income is equal to the function of educational level, years of experience, or industry plus error. And here F represent the relationship between our predictors and income. And we include an error term to acknowledge that our model won't be perfect. You have to remember here, finally, that the goal of modeling isn't just to capture reality perfectly. It's impossible in general, but Instead, we are aiming to create a useful tool that helps us make better decisions in complex situations. And for example, in the world of credit risk, these models are invaluable actually in terms of making faster, more consistent, and more accurate lending decisions. So there are two main types of credit risk models. The first one is the application model, used for the loan at the loan application stage. And the second one is behavioral model, used throughout the life of the loan. And application models here are our first line of defense. They usually used when a customer applies for a loan, and they help us decide whether to approve the application and on what terms. And these models typically use, for example, demographic information like age or occupation, and requested loan parameters such as amount and term. It may also use, for example, credit bureau data and any other information available at the time of application. For instance, an application model might tell us that based on the applicant's steady job history and good credit score, they are likely to repay a loan, but we should cap the amount up to $10,000 to manage our risk. And on the other hand, behavioral models come into play after we issued a loan. They usually help us monitor the ongoing risk on our loan portfolio, and usually these models use all the data from application models plus, for example, the additional ones like actual loan parameters, which might differ from the first initially requested, like behavioral factors like payment history and the current loan, for example, uploaded credit bureau information, and so on. And in general, behavioral model might alert us that a previously reliable borrower has, for example, has some problems in missing payments on the other loan, signaling increased risk. And beyond these core models, we also can use specialized models for things like estimating the likelihood of loan approval, predicting income, or, for example, optimizing debt collection strategies. And here, the key takeaway is that modeling and credit risk is an ongoing process. So in other words, we're constantly updating our view of risk as new information becomes available, which allows actually us to make dynamic data-driven decisions throughout the customer life cycle. So let's talk about the individual credit ratings, which in practice is a powerful tool that's becoming increasingly important in our even data-driven world. So an individual credit rating is like a financial report card, and it's a score that aims to summarize a person's credit worthiness, which is based on the wide range of data. This isn't just about the post-loan repayments, and it can include, for example, credit history from internal bank data and credit bureaus as well, reliability indicators from government sources, financial activity data from other banks, and even social media activity in some cases. But now, why this is important? Because it's important because this rating isn't just used by banks. It's valuable in general for individuals themselves, for self-improvement, for example, employers during hiring process, government agencies when providing services or subsidies, for example. And for example, in some countries, a good credit rating might help you, for example, to rent an apartment more easily or get a better rate on your, say, car insurance. And The trend we're seeing is towards more comprehensive ratings. For example, we started with simple credit history scores, but we are moving towards complex success indices that might predict income potential or career growth. But however, with this power comes responsibility for sure, because if we are bankers or financial professionals performing this kind of work, so we need to ensure these ratings are fair, transparent, and used ethically. We don't want to create a Black Mirror scenario, for sure, where a single score, for example, dictates every aspect of a person's life. But the key is here to use these ratings as one of the tools among the others, but not as the sole decision maker. So now let's dive into the concept of integral scoring, which is a powerful tool or approach that revolutionizing how we assess credit risk. For example, integral scoring is like making a soup. We can compare it to that. Why? Because we are combining here multiple ingredients to create something more flavor and nutritious than any single ingredient alone. And in this case, in our case, we are blending, first of all, the client's application data, things like age, income, and employment status, for example, credit history data, often from credit bureaus. And combining all of this, we get a more holistic view of the applicant. It's not just about whether they have paid loans in the past, but also about their current financial stability and future potential. And in general, this integrated approach allows us to make more nuanced decisions. For instance, we might approve a loan for someone with a short credit history, for example, in case if their current job and income are very stable. Or we might offer a low interest rate to someone with a few past credit issues, but a strong current financial position. Or here, the real power of integral scoring comes usually in how we use it. It feeds into two crucial calculations. First of all, risk-based lending, or RBL, which helps us determine the maximum loan amount we are comfortable offering. Then risk-based pricing, or RBP, which usually helps us set up appropriate interest rates that reflects the borrower's risk level. And in general, finally, by using integral scoring, we are usually able to say yes more often, while still we can manage our risk effectively. And it usually allows us to tailor our offerings to each individual customer rather than, for example, using a one-size-fits-all approach. Okay, here on this slide, credit bureau scoring is like getting a background check on a potential borrower. It's based usually on their past credit behavior, both in our bank and with the other lenders. And here, let me tell you, it's one of the most powerful predictors we can have. Why is it so important? First of all, because past behavior is often the best predictor of the future behavior. And if someone has, for example, consistently paid their bills on time for years, that's a good chance they will continue to do so. In our credit factory, on the credit factory of the bank, this process of the data interchange with the credit bureaus usually an automated loan decision process. Yeah, and here the final score considers both positive and negative factors. On the positive side, for example, maybe long credit history, successfully repaid large loans, or early loan repayments, for example. And on the negative side, maybe late payments, increasing debt levels, current overdue debts, and so on. And one of the interesting points here, we give more weight to internal credit history, but the customer has behaved with our bank in the following way. For example, according to the internal credit history, we treat it as more important usually. And usually customers with a negative credit bureau score are often automatically rejected. This might seem harsh, but remember that we're not just protecting ourselves, we are also protecting customers from taking on debt they can't handle. So this is a two-side or both directions treatment. However, a good credit bureau score doesn't even guarantee approval. Why? Because it's a crucial piece of the puzzle, but we always look at the full picture, at the integral scoring, for example, before making a decision. But the beauty of credit bureau scoring here is that usually allows us to make fast, consistent decisions while still considering each customer's unique credit profile. And in general, this is for sure a cornerstone of modern and data-driven lending. So now let's shift gears and talk about something that keeps risk managers up to the night. It's fraud. Specifically, let's discuss our fraud detection card, or FDC, scoring model. The FDC in general, we can treat it as our first line of defense against fraudsters. It's like a bouncer at a club deciding who needs to be checked more thoroughly before being let in, for example. And the FDC model looks at two main things. The first one is application data, or the information the customer provides. And the second one is credit history data, what we know about their past behavior. And based on these inputs, the model usually calculates a fraud risk score. This score then determines how deeply we need to verify the customer's information. It's not the point of rejection, so it's just the point of the more thorough analysis of the customer. Here, if you look at the table on the slide, the colors represent different levels of verification. For example, green is low risk, or it needs minimal check needed. And yellow is medium risk, so standard verification. And red is usually high risk, or in-depth verification required. And here, the black is very high risk, like automatic rejection, for example. And now we might be wondering, for example, why this actually work. For example, let us share some numbers to prove it. For example, for secured loans, the decrease is even higher. If we start from the first one, so we actually can see a 10 to 12% decrease in early stage delinquencies, less than 30 days, for example, for unsecured consumer loans. And therefore, for secured loans, the decrease is even higher. It's about 15 to 17%. And our average loan processing time actually may decrease up to 30%, up to or due to the first FDC scoring check. So the next thing is RBL scoring, or risk-based limit scoring. You can think of the RBL as a way to answer in the question, for example, how much can we safely lend to this person? It's like a personal tailor for credit limits, which ensures each limit fits the customer perfectly. And RBL here takes into account three key factors. The first one, individual client data, things like income, employment status, and credit history. And the second one is statistically calculated risk factors, like our assessment of how likely the customer is to repay. And the final thing is overall credit portfolio status. For example, how much risk we are comfortable taking on as a bank. And here, the beauty of RBL is its flexibility usually. Why? Because we can usually adjust our approach quicker based on the changing business goals or new statistical data. And for example, if we want to grow up our portfolio, we can dial up the limits. So simply. And we need to be more conservative. We can dial them back, for example. Let me show you the impact of this, therefore. For example, we can compare our previous model to the RBL model. And we can see here that RBL may show us to offer high limits to our best customers while still managing our risk effectively. And in fact, since implementing RBL, so a bank may see on average maximum credit limit increase by up to 5% due to that. And that might not sound actually like much, but spread across our entire portfolio, it may represent significant growth potential in terms of our lending activities. And here is the key. We're not just giving everyone high limits, but RBL allows us to be more nuanced. We're giving high limits to those who can handle them, while potentially lowering limits for high-risk customers. And in general, this approach benefits everyone. For example, customers get limits that better match their needs and capabilities, and we, as a bank, grow our portfolio while keeping risk in check. Let's talk about the final piece of our risk-based lending puzzle, which is risk-based pricing, or RBP. If RBL helps us decide how much to lend, therefore RBP helps us decide at what price to lend. In general, it's our way of ensuring that the interest rate we charge accurately reflects the risk we are taking. And the main principle behind RBP is simple but powerful. High risk should come with a higher price. It's like insurance in general. A safer driver pays less for car insurance, for example, than the driver with history of accidents. And here, how it works. We start with this rate that covers our basic cost and, for example, unexpected losses. And then we add a risk premium that is calculated based on the probability of default, exposure default, and loss given default as well. We can look at the formula on the right on this slide, and this formula might look complex, but it is essentially the same. The riskier the loan, the higher the premium we need to charge to cover our expected losses. And here on the slide, if we look at the chart on the left, so it shows how interest rates vary based on the risk. As you can see, higher risk borrowers pay higher rates here because of the spread, risk spread. And now we might thinking, for example, isn't this unfair to high risk borrowers? But consider the alternative here. Without risk-based pricing, we would have to charge everyone a higher rate to cover our losses on high-risk loans, for example. But RBP allows us to offer lower rates to lower-risk borrowers. And moreover, RBP allows us to say yes to more borrowers as well. For example, instead of rejecting a high-risk applicants outright, we can offer them a loan at a higher rate that reflects their risk level. Okay, and let's wrap up our discussion by talking about the role of rating agencies in the broader sense of the financial ecosystem. So we can think of rating agencies as the credit bureaus of the corporate and government world. Just as a credit bureau, credit score helps us as banks assess an individual's creditworthiness, for example, these agencies help investors assess the creditworthiness of companies and countries. And the big three agencies, for example, Standard & Poor's, Moody's, and Fitch, they really dominate this space. Together, they control for about 95% of the market. For example, with S&P and Moody's each holding about 40% and Fitch about 15% of the market. And these agencies assign letter grades to indicate creditworthiness. For example, if you look at the table, you can see that AAA or AAA is the highest rating here, indicating the lowest risk of the default. And we move down the table and the risk increases. Now you might wonder why we need these agencies. Can't investors do their own research, for example? Yes, but these ratings usually provide a standardized, easily comparable measures across different entities. Then they have access to non-public information that individual investors don't, and they have teams of analysts with deep expertise in specific sectors and regions, and therefore the ratings of these agencies provide the ratings for different countries. For example, they influence the interest rates at which companies and governments can borrow even. And they use the regulatory requirements for banks and insurance companies as well, and they are often referenced in investment fund mandates. However, it is crucial to remember that these ratings aren't infallible. For example, the crisis of the 2008, during this crisis, many AAA rated mortgage-based securities turned out to be junk, as a stark reminder of this. And at financial professionals, for example, bankers, we need to use those ratings as one tool, as one of the many tools actually, but not on the sole basis for sure for decision making. Okay, we have come up to the next question. So I will give you a couple of minutes to answer this. So the question is, what is the primary purpose of risk-based pricing in credit scoring? Please write down your answer into the chat. Yes, you're quite right. So answer 3 is quite right. So because this kind of modeling is used to align the interest rate of the loan with the borrower's risk level. Yeah, that is quite right. Do you have any questions on that? If not, we will go on. Okay, the next topic of our today's lecture is structural models of credit risk, and we will go through them and through the keystone of the structural models, Merton model. This is really a fundamental concept to risk management that you will encounter throughout your careers as risk management, possible careers. Unlike reduced form models, structural models give us insights into why a company might default, not just when. And they're like, say, X-rays for a company's financial health. Let's break down the key differences between structural and reduced form models, and you will see why this matters in real-world risk management. So, therefore, let us compare structural and reduced form models side by side. Here, the key difference is their assumptions about information. Therefore, structural models assume we know everything about the company's finances, and it's like having a crystal ball for the company's future. But in contrast, reduced form models are more like regarding it's like considering tea leaves from market prices. They don't try to peek inside the company's books. And for example, when assessing the risk of lending to a tech startup, say, a structural model would have you analyze their assets, debts, and cash flows, for example. On the other hand, the reduced form model would look at how the market prices their bonds. But in my experience, both approaches have their place, actually. And the trick here is knowing when to use each of them. So let's talk about the man behind the model, who is Robert Merton. And it's not just any economist. He's a Nobel Prize, actually, winner, and a true pioneer in finance, actually. Merton's journey is fascinating. He first bought his first stocks at, for example, 10 years old, and that is how he started. And therefore, his academic path is a testament of the interdisciplinary future and nature. And from engineering to applied math to economists, so each step built him towards his groundbreaking work. So, and as we go through the Merton model, please keep in mind the brilliant mind behind it. It will help us to appreciate the elegance of the theory. Okay, the Merton model didn't just appear out of the air, for sure. It was the result of the intense collaboration and intellectual ferment at the MIT, which is a Massachusetts institution of technologies at the early 70s. And the Black-Scholes well-known paper in 1973 was a game changer, but Merton took it a step further, applying option pricing to corporate debt. And this is a great, this is a great example of how academic research can have profound real-world impacts. And for example, today, these models underpin much of the modern risk management, therefore. So now we are getting to the heart of the Merton model. The key insight here is brilliantly simple. which is the company's equity is like a call option on its assets. So this is a key idea of the model. We can think about it. If a company's assets are worth more than its debt, then shareholders win for sure. If not, they walk away. So sound familiar? It's exactly how a call option works. And this approach allows us to use option pricing theory to value companies and assess their default risk. It's like having a Swiss Army knife for corporate finance. But in practice, for example, I've seen this model used to quickly assess the health of the hundreds of companies in a portfolio simultaneously. It's not perfect, but it's a really powerful screening tool. And you should remember here that, like any model, it has its limitations, which we will discuss further on. So now let's break down the key ingredients of the Merton model. Here we have three main components. First of them is firm value, company value, equity, and debt. And the relationship between them is very simple. So it's just an addition of the equity function to the debt function, which is the foundation of the model. It's essentially saying that a company's value is the sum of its equity and debt. But in real life, estimating these values can be tricky because equity is straightforward for public companies, but firm value and debt can be more complex. As you could work, for example, with this model, you will or you might develop a feel for these companies and how they interact. It's like developing a sixth sense for corporate financial health, in other words. So the next model is being called a KMV model, which actually takes Merton's ideas and turns them into a powerful tool for credit risk assessment. KMV stands for Kohlhofer, McQueen, and Vasicek, who are three smart folks who saw the potential in the Merton's work. And here the key insight was the credit ratings alone don't tell the whole story. For example, two companies with the same rating could have very different default risks, actually. And the expected default frequency, or EDF, here, the metric they developed is like a credit rating on steroids. It's dynamic, quantitative, and firm specific. So here is the KMV model. Now let's dive into the math behind the KMV model. So the distance to default, or DD, is the key metric here. So we can think about it as a measure how far a company is from the default cliff. And the formula of DD here, as you can see on the slide, might look familiar. It's essentially D2 from the Black-Scholes Merton option pricing formula. So, but we can see how all of these measures are interconnected between each other. And as I said before, the expected default frequency model is then derived from the distance to default model. It's really the probability of the company's assets will be less than its debt at maturity. And in practice, calculating all of these metrics can be challenging, actually, because we need to estimate asset volatility, which isn't directly observable, but the insights you gain are invaluable here. So, taking into account or considering the different metrics, the different components of the distance to default formula, so V here represent the market value of the company's assets, and D represent the face value of the company's debt at the default point. and alpha is the expected return of the firm's assets, sigma multiplied by V in the volatility of the firm's asset value, and T minus T is a time horizon, usually 1 year from the current time, small t. And this formula calculates how standard deviations the firm is away from the default point, taking into account the firm's current asset value, debt level, expected asset returns, and asset volatility. A higher distance to default indicates a lower probability of default, as the firm's assets are further away from the default threshold. And finally, this model is widely used for the financial industry for credit risk management, for example, and it has been influential in the development of more advanced credit risk models. Okay, let's look at the real-world example of the Merton model application. So let's go back to the mid-19s and looking at Apple company. It might be hard to believe now, but Apple was struggling back then. So the model gave, for example, them for about 15% chance of defaulting within a year. And this is a great example of how the model can quantify risk. For example, a 15% default probability is really significant, and it would make any lender think twice whether to lend money to the fallen appropriate company or not. But here is a kicker. Apple didn't default, as we know. And this shows both the power and the limitation of the model. So it's a tool, in other words, not a crystal ball. I always usually use this example to remind my, for example, risk management teams that models are guides, not a gospel. And they need to be committed with qualitative analysis and expert judgments as well. And here we can see the detailed results for the Apple company. You can notice how the probability of default increases as we look further into the future. And this makes intuitive sense. The further out we look, the more uncertainty there might be. But seeing it quantified like this is powerful. And in risk management, we often focus on a 1-year probability, but this longer view can be really crucial for strategic planning, for example. So there is another case where we can look at the default actually happened. It's Jackson Hewitt Tax Services. The model showed significantly higher probabilities of default in the year before they actually defaulted in August 2011. And this is where the Merton model really shines. So it can provide early warning signals of financial distress, for example. But you should remember here that high default probability doesn't always mean default will happen. This is just a warning sign, not a death sentence. And companies can and do turn things around. After the Merton model, for example, showed they might be defaulted in a year. Okay, now let us turn to the Vasicek model. This is another heavyweight in the world of credit risk modeling. What is about the Vasicek model? So it builds on Merton's work, but it takes things a step further. For example, it is designed to handle portfolios of debt, but just of the individual companies. And this model had a huge impact on the financial industry indeed. Its key component was used by the Basel II framework for bank capital requirements, for example. So as we go through this, we have to think about how it compares to the Merton model, and what are the similarities, for example, what are the differences, and how might you use each of these models. Okay, let's break down the key features of the Wasserchuk model then. There's a lot to unpack here. First of all, it's a single period model, which means we are looking at a fixed time horizon, typically 1 year. Secondly, it's designed for portfolios, not just individual loans. And this makes it incredibly useful for banks, for example, and other large lenders. And then the model links default probability to the company's asset value, similar to Merton's approach. And one interesting aspect here is how it handles capital structure. And for example, the model suggests that equity should match a certain percentile of the loss distribution. But in practice, I've seen this model used to set loan loss reserves and determine economic capital. It's a powerful tool for risk managers, in other words. Let's get back to the Wasserchuk model. The key here is the decomposition of risk into systematic and specific factors. This is really crucial for understanding portfolio behavior. In this model, one component represents systematic risk. It's like overall state of the economy. So it affects all the companies. And another component is a specific risk for each firm, for example, for each company. And this is what makes each company unique. So here is the mathematical expression of the Wasserchuk model. It might look really simple, but there is a lot packed into the equation. For example, the square of P coefficient is really crucial here, as you can see, because it shows how exposed a borrower to the systematic risk. And in real life, for example, estimating this coefficient is a big part of the challenge. Because why? Because it requires careful analysis of historical data and even industry trends. And as we can look at this formula, for example, further, we have to think about how you might estimate these values for different types of companies, or how would it differ from a tech startup versus a utility company. Therefore, every model has its own assumptions, as you may know, and the Wasserchuk model is no exception here. And let's break them down. The equal correlation assumption is a big one, for example, because it simplifies the math, but it's not always realistic, as you understand. Now, the assumption of non-unequal default probabilities is also a simplification here, because in reality, we often have to estimate these figures. And the large portfolio assumption is crucial for the law of large numbers, as you may know. So here's an equation for the Wasserchuk model for the value at risk calculation. The formula looks complex, but here each piece of the formula has a clear interpretation. Here R is our correlation factor in the formula, and LGD, as you can remember, is a loss given default. And 99.9% of confidence level is set by the Basel II standards, and it is very conservative standards because we are looking at extreme tail events here. And in practice, calculating value at risk is often an overnight process for banks running on powerful computer clusters. And so here how it works. Okay, then let us perform the introduction to the key credit metrics model, which is another structural credit risk model developed by the JP Morgan to assess portfolio risk. So it's something at the middle of the structural credit risk model and portfolio risk models. As I said before, it was developed by JP Morgan Investment Bank in 1997. And this model has become a standard for the industry, actually, since that times. And the key difference here is the focus on credit quality changes, not just on default. So we have three key elements of the credit model here. First, the transition matrix, which shows actually the probability of a company moving from one credit rating to another. It's like a roadmap of the credit quality changes, in other words. Second is we have correlations between rating changes. And this is really crucial for portfolio analysis because it helps us understand how risk might be compounded. And finally, we have yield curves for each rating here, which allows us to value instruments across different credit qualities, for example. Let's walk through the credit metrics process. It's like a bit like following a recipe. Each step builds on the last. So here we start by determining the current credit rating. This is our baseline, actually. Next, we estimate transition probabilities. This is where the transition matrices come in handy. And then we calculate value changes for each possible rating shift. This is where it gets interesting, actually, because ratings change can have a big impact on the value of the portfolio. And the joint model and step is crucial, actually, here, because this is where we account for correlations between different borrowers. And finally, we construct the distribution of portfolio value changes, which gives us our risk metrics. Okay, we have come up to the next following question. Please select and write down your answer to the chat, and I will give you a couple of minutes. So the question is, which of the following statements about structural credit models is not correct? Okay, so the answers are such different, actually, but nevertheless, thank you for your answers. So, in fact, the correct answer is fourth, actually. Why? Because reduced form models do not explicitly link defaults to the firm's financial condition, actually. And this characteristic is actually associated with structural models. But on the other hand, reduced form models instead rely on market prices of financial instruments to determine, for example, default probabilities, treating defaults as an exogenous event. So therefore, the fourth answer is right. Okay, any questions? So if you do not have any questions, so let's go on. So the next topic will be devoted to the credit portfolio models, which is a continuation of the previous topic, actually. So credit portfolio models are really essential tools in modern risk management for any financial institution. Why? Because first of all, they help quantify and manage credit risk at the portfolio level, and which allows capturing diversification effects, for example. We'll be taking an in-depth look at the two prominent models, for example, which are Credit Risk Plus and Credit Portfolio View. Because these models go beyond individual loan analysis to provide a so-called holistic view of portfolio risk. And in other words, understanding this methodology strengths and limitations is really crucial for effective risk management. Okay, The purpose of these models is to estimate potential losses in credit portfolios due to defaults and rating migrations. And key components include here default probabilities, exposures, and correlations between borrowers. And the main output of these models is the loss distribution of the credit portfolio overall. This really provides insights into expected and unexpected losses, which is critical for capital allocation and risk-based pricing. For example, a bank may use the model to determine how much capital to hold against the corporate loan portfolio. We'll be focusing on two prominent credit portfolio models with distinct approaches. The first one is Credit Risk Plus, which was really developed by the Credit Suisse Bank, and it uses an actuarial, I would say, approach based or focused on default events. And Credit Portfolio View model was developed by McKinsey, and it incorporates macroeconomic factors and credit migrations as well. While both of these models aim to capture portfolio effects and correlations, they do so through very different methodologies, actually. So let us go deeper into the Credit Risk Plus model then. As I said before, it was developed by the Credit Suisse Financial Products Department of the Credit Suisse in 1997. And it takes an actuarial approach to credit risk, which is similar to methods used in insurance mathematics, for example. This model focuses primarily on default risk rather than considering rating migrations. And the key advantage here of the model is computational efficiency, especially, for example, for large portfolios. Moreover, it provides an analytical solution for the portfolio loss distribution, avoiding the need for time-consuming simulations. And another model is Credit Risk Plus. So the same model, sorry. Credit Risk Plus, it assumes default events follow a Poisson distribution, treating them as, for example, rare events. And this allows for the probability of multiple defaults by a single obliger. Through this is unlikely in practice. And default rates here are treated as random variables modeled using gamma distributions. And this really captures uncertainty in the level of default rates and reflecting real-world volatility as well. Exposures here are assumed to be fixed and known, and it simplifies actually calculations, but may not reflect reality for all instrument types. And the recovery rates are treated as deterministic here, though they can be adjusted to reflect the seniority of exposures, for example. Okay. Moreover, Credit Risk Plus uses a sector analysis, which is an approach to model correlations. And sectors can represent industries, geographic regions, or other risk drivers, for example. And here, each sector has a gamma distributed default rate, reflecting volatility within that sector. And obligers can be influenced here by multiple sectors, allowing for a flexible representation of risk factors as well. And here, default correlations are implicitly modeled through these sector dependencies. For example, two companies in the same industry would have correlated defaults due to shared sector exposure. So in Credit Risk Plus, the number of defaults in a sector follows a Poisson distribution, as I said. And the parameter of the Poisson distribution is the sector's default rate, which is gamma distributed. This combination, in other words, the Poisson distributed default with gamma distributed rates results in a negative binomial distribution for a number of defaults in each sector. And this mathematical result is a key to enabling analytical solutions in the model. And otherwise, it allows us to capture both the randomness of default events and the uncertainty in default rates. So, Credit Risk Plus uses an analytical approach with probability generating functions to derive the portfolio loss distribution on an overall basis. Actually, this avoids the needs for Monte Carlo simulation, making it computationally efficient. And the process involves deriving the loss distribution for each sector, then convolution this to get the portfolio distribution as well. And here the results in closed form solution for the portfolio loss distribution is in place. And this enables quick calculation of risk measures like value at risk, for example, or expected shortfall. So if I'm not mistaken, here we come up to the break. Yeah, sure. So let's break for, say, 10 minutes, if you don't mind. Okay, it's time to get back. So do you hear me well? Do you see the presentation? Yeah, great. So let's go on. So let's consider the strengths and weaknesses of the Credit Risk Plus model. The major strength of Credit Plus is its computational efficiency. For example, the analytical solution means no simulation is required, and it allows to handle very large portfolios quickly, for example. It focuses on defaults, which are often the key risk driver for credit portfolios. And this model also captures uncertainty in default rates, providing good estimates of tail risk. And it's relatively simple to implement and calibrate, making it accessible for many institutions, for example. And finally, its transparent methodology allows for easy explanation to stakeholders, and this is really crucial for the risk governance. So, and what are the limitations or shortcomings of the model? Credit Risk Plus does not model rating migrations, which really may underestimate risk for some portfolios. Then it assumes fixed exposures, which may not be suitable for portfolios with significant exposure fluctuations, for example. The model has limited handling of recovery rate, assuming them to be deterministic. And then the Poisson assumption allows for multiple defaults by a single obliger, which is not always realistic. And the correlation structure might be too simplistic for some complex portfolios. And it does not explicitly incorporate macroeconomic factors, which can be a significant driver of credit risk, for example. So then let us introduce ourselves to the credit portfolio view model. As I said before, it was developed by McKinsey company in the late 1990s. And a key feature here is its incorporation of macroeconomic factors into the credit risk modeling. It models, first of all, both defaults and rating migrations, providing a more comprehensive view of credit risk. And the model is actually designed to capture the impact of economic cycles on credit risk. And finally, it allows for segment-specific responses to economic conditions, reflecting portfolio heterogeneity, so-called heterogeneity. So then what is about assumptions of the model? So now credit portfolio view assumes that default and migration probabilities depend on the economic cycle, first of all. Then this recognizes the credit risk is not constant over time, but fluctuates within economic conditions. Then the model allows different segments to react differently to economic conditions, and it incorporates country and industry risk, capturing systematic risk factors which affect groups of obligors, for example. And economic conditions can be modeled and simulated, enabling scenario analysis and stress testing here. And for example, you could model how regression might impact default rates across different industries by means of the model. Credit portfolio view in overall has two models of operation: CPV macro and CPV direct. So in general, it uses conditional transition matrices, which those suggest standard matrices for economic conditions. And the model incorporates a systematic risk model to generate scenarios for economic conditions. And it allows for multi-period analysis, projecting credit risk over multiple time horizons. Therefore, and this overall framework provides a flexible approach to modeling, for example, complex economic relationships and their impact on credit risk. CPV macro links macroeconomic factors to default probabilities using regression models here. And each segment can have its own regression model, allowing for segment-specific sensitivity to macro factors. And here, macroeconomic factors might include GDP growth, unemployment rates, interest rates, stock market indices, and industry-specific indicators. And here, the regression models capture both the level and the volatility of default rates. And for instance, you might find that the tech sector is more sensitive to stock market performance, while manufacturing is more sensitive to GDP growth, for example. Here, the next component of the model, CPV Direct, directly models segment-specific default probabilities. In general, it uses a gamma distribution for default rates, similar to credit risk plus in this aspect. And this approach offers simpler calibration compared to CPV macro, for example. It doesn't require extensive macroeconomic data, which can be advantageous in some markets. And CPV Direct here still captures volatility in default rates and allows for correlation between segment default rates. And these can be, in other words, these can be useful when detailed macroeconomic forecasts are unavailable or unreliable. Here, the systematic risk model within the overall model generates macroeconomic scenarios, and these can be based on historical data or user-defined scenarios for stress testing, for example, and it calculates conditional default probabilities for each scenario as well. And here, a logistic function links the macro index to default probability, ensuring probability stay between 0 up to 1. And in other words, this allows for stress testing by manipulating macro scenarios. And for example, you could model the impact of severe recession on your portfolio's credit risk by means of the model. So also, credit portfolio view uses a shift algorithm to adjust transition matrices based on economic conditions, which incorporates both upgrades and downgrades, capturing the full spectrum of possible rating changes. And it reflects how economic conditions impact credit quality across different rating classes, for example. For instance, you might see more downgrades during a recession, especially for lower rated credits. And the model preserves key properties of transition matrices such as rows, assuming to 1. And this approach actually overall provides a more nuanced view of credit risk than models that only consider defaults. Therefore, credit portfolio view employs Monte Carlo simulation of macroeconomic scenarios. And here, for each scenario, it calculates conditional default probabilities, adjusts transition matrices as well, simulates defaults and migrations, and calculates portfolio losses. And this process overall is repeated many times to generate a range of possible outcomes. The results then are aggregated to produce an unconditional portfolio loss distribution. And finally, this approach reflects uncertainty in both economic conditions and in credit events. And it provides as well a rich set of outputs for risk analysis and decision making. So, a key strength of credit portfolio view is its explicit incorporation of macroeconomic factors. Therefore, it models both defaults and migrations, providing a more complete picture of credit risk, as you know, and then the model allows for segment-specific responses to economic conditions, capturing portfolio heterogeneity, and then it enables detailed scenario analysis and stress testing as well, which may be useful for capital planning and for the risk management as well. And the multi-period analysis capability here makes it suitable for long-term risk assessment. Now, for example, you could use this model to project how your portfolio's risk profile might evolve over a 5-year business cycle. Just a sec. So let us continue. In general, credit portfolio view requires complex calibration, especially for the CPV macro part. Then it needs extensive macroeconomic data, which may be challenging in some markets or for some segments. And the model can be sensitive to specification choices, for example, such as which macro factors to include. And it's computationally intensive, requiring substantial resources for large portfolios. And there is a risk of overstating the link between macro factors and credit risk, as economic relationships are not always stable for sure. And overall, these limitations underscore the importance of careful model validation and ongoing monitoring. Okay, as for comparison of the model approach, Credit Risk Plus here takes an actuarial approach, focusing on modeling the number of defaults. It uses Poisson and gamma distributions as its mathematical foundation, while credit portfolio view uses an economic cycle-based approach, modeling both defaults and migrations. And it also employs regression model or direct probability modeling. And both models capture portfolio effects, but through different mechanisms. So understanding these differences is really crucial for interpreting model outputs and choosing the right approach for your portfolio. Another part of comparison, correlation, which is correlation modeling. So Credit Risk Plus models correlation implicitly through sector analysis, and obliges here in the same factors are correlated, but the correlation structure is relatively simple. While credit portfolio view models correlation explicitly through macroeconomic factors. This allows for more complex correlation structures and can capture time-varying correlations as well. And the choice between these approaches depends on the complexity of our portfolio and your view on how correlations arise. For example, if you believe industry factors are the same main factor for correlations, then credit risk plus might be sufficient. But if you think broader economic factors are key, then credit portfolio view might be more appropriate, for example. What about the computational aspects of the models? So here, Credit Risk Plus provides an analytical solution, making it very efficient, specifically for large portfolios. It allows, for example, for quick calculation of risk measures, which can be advantages for daily risk measurement and management. And credit portfolio view is simulation-based, making it more computational intensive. However, this allows for more detailed analysis and scenarios, and the trade-off between speed and detail is an important consideration in model selection here. So therefore, your choice might depend on factors like portfolio size, available computing resources, and required analysis frequency. So what for the input requirements? Here, Credit Risk Plus requires inputs like default rates, exposures, sector weights, and optional recovery rates. These are typically readily available within most financial institutions. While credit portfolio view needs macroeconomic data, for example, for the CPV macro part of it, transition matrices as well, segment definitions, and historical default and migration data. And these more extensive data requirements can be both a strength and a challenge. And the availability and quality of this input should be a key consideration in model selection. Therefore, and if you lack, for example, reliable macroeconomic forecasts, then CPV Direct or Credit Risk Plus might be more appropriate choices. In terms of output and interpretation of the models, here Credit Risk Plus emphasizes tail risk and unexpected losses, making it good for economic capital calculations. However, it has limited ability for scenario analysis. And credit portfolio view provides detailed scenario analysis and stress testing capabilities. It can project risk over multiple time periods and provides insights into economic sensitivities. And the choice here between these models might depend on the primary use case. For instance, if your main goal is setting economic capital, then Credit Risk Plus might be sufficient. If you need to do extensive stress testing, for example, then credit portfolio view might be more appropriate. What for the model selection considerations? So here, portfolio characteristics and diversity are usually key factors in the model selection. For example, available data and resources will constrain your choices and influence model performance. Regulatory requirements and internal risk management needs should guide your decision usually. And we should consider as well the desired balance between model complexity and interpretability. And we should think here, thinking about the application of the model, about our need for scenario analysis and stress testing capabilities. And in conclusion, both Credit Risk Plus and Credit Portfolio View models offer valuable insights into portfolio credit risk, while Credit Risk Plus excels in efficiency and simplicity, while Credit Portfolio View provides rich scenario analysis. And our choice should depend on the specific needs, data availability and risk management philosophy, for example, as well. And here, best practice often involves using multiple models for a comprehensive view. And the field of credit risk modeling continues to evolve in general, promising further advancement. But regular review and validation of model performance is really crucial here. So here's another question. Which of the following statements best describes a key difference between credit risk plus and credit portfolio view? Please select one of the options here and write out down in the chat. Sorry. Yeah, thank you for the remind. Yeah, my microphone was turned off. So I will start from the beginning. So do you hear me well now? Yeah, sorry once again. It's my fault. Yeah, so we are going on the another topic which is credit derivatives, like credit default swaps and credit linked notes. So let's start by defining what we mean by credit derivatives. These are actually, in general, these are financial instruments which are designed to transfer credit risk between parties. And for example, we can imagine if we work in the bank, which has a large loan portfolio, for example, then credit derivatives gives us the ability to manage our exposure to potential defaults without actually selling off our loans. And here, one key insight is that credit derivatives allow us to separate credit risk from other types of risk associated with the loan or bond, for example, or debt. And this separation has actually revolutionized how financial institutions manage risk. And it's like being able to insure against a specific risk without having to sell, for example, your entire house. So let us consider what are credit derivatives. Credit derivatives are contracts that allow parties to transfer credit risk without transferring the underlying asset. And this is a really crucial distinction. We have to think about that. What if we do not need to selling the actual loan or bond, for example? We are just transferring the risk associated with a potential default on that loan or bond. And the value of these derivatives, by the way, comes from the creditworthiness of the underlying entity. This could be a corporation, a government, or any other issue or debt. And one of the fascinating aspects of credit derivatives is how they have created a market for credit risk itself. Because before these instruments existed, credit risk was always bundled with other aspects of a loan or bond. And credit derivatives here serve several crucial purposes in financial markets. Let's break down. First, risk management. This is perhaps the most straightforward use. While banks and other lenders can use credit derivatives to hedge their credit exposure to potential defaults. And second, yield enhancement. For example, investors can gain exposure for or to credit risk without actually owing the underlying bond. And this can be attractive in low yield environments. And third, regulatory capital management as well. This may be a big one for banks, while credit derivatives can help banks optimize their capital requirements under, for example, regulatory frameworks like Basel III. And lastly, price discovery. That means that the market for credit derivatives provides valuable information about how the market perceives credit risk for different entities, for example. Okay, types of credit derivatives. While we are focusing on CDS and CLN today, it's important to understand that there are various types of credit derivatives either. Let's quickly run through them. First, credit default swaps, or CDS. They are like insurance against default. So we'll dive deeper into this shortly. And then goes credit linked notes, or CLN, which combine a bond with CDS. These are actually particularly interesting for investors who face restrictions on, for example, trading derivatives directly. Then goes total return swaps, or TRS, which transfer the total economic performance of an underlying asset. And then we can consider credit spread options, which allow investors to take positions on credit spreads without direct exposure to the underlying credit, for example. Then collateralized debt obligations, or CDOs, which pull together debt instruments and issue new securities based on this pool. And overall, each of these instruments has its own unique characteristics and users. And as we go through CDS and CLN in detail, we have to think about how these other types of instruments might complement or differ from them. So let's dive into credit default swaps, or CDS. At its core, a CDS is a financial contract that provides insurance against the risk of a default. And here's how it works. First of all, the seller of the CDS agrees to compensate the buyer if a loan default or other credit event occur. In return, the buyer makes periodic payments to the seller. And this is like a car insurance. So you pay premiums regularly, and if you get into the accident, for example, or in this case, the credit event occurs, the insurance company pays out. And one key insight here is that you don't need to own the underlying asset to buy a CDS on it. This really opens up possibilities for both hedging and speculation. So, therefore, structure of a CDS. Let's break down the structure. First of all, we have the protection buyer. This is a party seeking to hedge credit risk or speculative on credit quality deterioration. And then there is a protection seller who assumes the credit risk in exchange for premium payments. And the reference entity is the issue of the debt obligation that the CDS is written on. Then the notional amount is the face value of the credit protection, and the premium is the regular payment made by the buyer to the seller, usually quoted in basis points per annum of the notional amount. And finally, the credit event is what triggers the payment from the seller to the buyer. And in other words, this could be a default, bankruptcy, or other specified event. So we have come up to the CDS pricing then. And CDS pricing is a complex topic, but let's cover the basics first of all. CDS are quoted in terms of spreads expressed in basis points per annum of the notional amount. And for example, if a CDS has a spread of 100, say, basis points, which is actually 1%, then the protection buyer must pay 1% of the notional amount annually to the protection seller. And several factors may affect CDS pricing here. First of all, the creditworthiness of the reference entity, which is obviously crucial. Then the term of the contract matters as well, which means longer terms generally command higher spreads. Then interest rates play a role, and they affect the present value of future cash flows. Then market liquidity can significantly impact pricing, especially for less commodity traded names. And then supply and demand dynamics, dynamics in the market also play a role. And in overall, in practice, sophisticated models are used to price CDS, often incorporating probability of default and expected recovery rates. And here, one interesting aspect of CDS pricing is how it can sometimes diverge from bond spreads for the same issue, say. And this can in other words, create arbitrage opportunities for saving traders. So, what are the uses of CDS then? CDS serve various purposes actually in financial markets, and now let's explore some of the main uses. First of all, hedging, which is perhaps the most straightforward use. While, for example, banks can use CDS to hedge the credit risk in their loan portfolios. Then speculation is another common use, which means traders can make views on credit quality without actually owning bonds. And these can be more capital efficient and offer greater liquidity as well. Then arbitrage. Arbitrage opportunities can arise when there are price discrepancies between CDS and bonds of the same issue, for example. And here CDS can be issued to create synthetic bonds by combining a risk-free bond with the CDS. And in other words, this can be useful for gaining exposure to credits that might be hard to access directly. And proxy hedging is an interesting use as well, when, for example, traders might use liquid CDS to hedge less liquid credit exposures that are correlated. CDS indices are an important innovation in the credit derivatives market as well. And these are credit risk CDS indices are standardized credit securities that track a basket of credit default swaps. And here, the two main families of CDS indices are CDX, which covers both North America and emerging markets, and iTraxx, which covers Europe and Asia. And these indices offer really several advantages over single name CDS. For example, they provide broader market exposure, allowing investors to take views on entire sectors or regions. Then they offer improved liquidity, which can be crucial in times of market stress. Then they are standardized, which reduces operational complexity. Then one interesting trend here is the development of bespoke indices tailored to specific investor needs. This, for example, combines the standardization benefits of indices with the customization of over-the-counter product. So, while CDS can be a powerful risk management tools, they can come with their own set of risks. And it's really crucial to understand this. For example, counterparty risk is a big one. If the protection seller defaults, the buyer might be left unprotected right when they need it most. And basis risk can occur when there is a mismatch between the CDS and the position it meant to hedge. And the correlation might not be perfect. Then the model risk is significant in CDS market as well. For example, if your pricing or risk assessment models are flawed, you can be taking on more risk than you realize, for example. And liquidity risk can be an issue, especially for less commonly traded names. In stress market, for example, it might be difficult to close our positions. And operational risks as well, such as errors in documentation or settlement processes, can also cause problems. So the regulatory landscape for CDS has changed dramatically since the 2008 financial crisis. And then let's look at some key developments. For example, in the US, the Dodd-Frank Act mandated central clearing for many types of CDS. And this was a really big shift from the previous over-the-counter model. In Europe, we saw similar changes with the European Market Infrastructure Regulation, and there's been a big push for increased reporting and transparency as well. while regulators want to have a clearer picture of where the risks in the system lie. And we've also seen higher capital requirements for non-centrally cleared derivatives as well. And this has pushed more trading towards central clearing as well. These changes aim to reduce systematic risk and improve market stability. However, they have also increased costs and complexity for market participants. In my view, in particular, while these regulations have or made the market safer in many ways, they've also had some unintended consequences. For example, the increased cost of trading has led to a concentration of activity among fewer but larger dealers, which is a risk itself. Now let's shift our focus to credit-linked notes, or CLNs. In general, these are structured credit products that combine a bond with an embedded CDS. And here, CLNs allow investors to gain exposure to credit risk while potentially earning higher yields than traditional bonds. This, in general, makes them particularly attractive in low-yield environments. And one key point about CLNs is that they are especially popular among investors who face restrictions on trading derivatives directly. This might include certain types of funds or even institutional investors. But in essence, a CLN package is credit risk in a format that looks and feels more like a traditional bond. And otherwise, it can make it easier for some investors to incorporate credit strategies into their portfolios. So let's break down the typical structure of CLN then. First of all, we have the issuer, which is usually a special purpose vehicle company. And this is a separate legal entity set up specifically to issue the CLN. And then the investor provides funding and assumes credit risk. They are effectively selling credit protection through the structure. And the reference entity here is the underlying credit risk being transferred. And this could be a single name or a basket of credits. There is typically a swap counterparty, often a bank that engages in CDS within the SPV. And further on, the SPV holds high quality collateral, which provides security for the note. And the investors receive coupon payments on principal at maturity unless a credit event occurs with the reference entity. So understanding the cash flows in CLN is really crucial here. Let's walk through them. First of all, initially, the investor provides funding to the issuer by purchasing the CLN. And the issuer then typically uses this funding to purchase high quality collateral. Then the investor receives regular coupon payments from the issuer, and these coupons are usually higher than what we'd get on a standard bond, for example, on a similar credit quality. So behind the scenes, the swap counterparty is making CDS premium payments to the issuer. And if no credit event occurs, for example, then the investor receives their principal back at maturity. However, if a credit event does occur, the investor may receive a reduced payment or potentially no payment at all. So, and at this last payment, that is crucial to understand that CLN investors are effectively taking on credit risk on the reference entity. So, CLNs come in various forms, each of which I would say has its own risk-return profile. So let's go through the main types. First one is single name CLN, which are linked to a single reference entity. And in fact, these are the simplest form and are often used for taking views on specific credits. Then basket CLNs are linked to multiple reference entities, and these offer some diversification benefits. Then first to default CLNs are triggered by the first default in a basket of reference entities. And these can offer higher yields, but come with higher risk. Then nth to default CLNs are triggered by the nth default in a basket. And these allow for more nuanced expressions of credit views. And index CLNs are linked to a CDS index, offering broad market exposure. And here, for example, each type of CLN offers different risk-return profiles and different diversification benefits. And the choice actually depends on the investor's specific needs and market views. So CLNs offer several advantages to the investors. Let's explore some of them. First, they typically offer higher yields comparing to traditional bonds of similar credit quality. And this yield can pick up can be attractive and especially in low yield environments. And they provide access to credit risk for investors who may face restrictions, for example, on trading CDS directly, which opens up credit strategies to a wider range of investors. On the other hand, CLNs can be customized to provide exposure to specific credits or sectors. And this flexibility is a key selling point actually here. Then they can offer diversification benefits in investment portfolios, for example, allowing investors to fine-tune their credit exposure. And finally, CLNs can provide synthetic exposure to assets that may be difficult to assess, for example, directly. This can be particularly useful for gaining exposure to emerging markets credits. So while CLNs can offer attractive yields, for sure, it's crucial to understand their risks. For example, credit risk of the reference entity, the most obvious here. And if a credit event occurs, then investors can lose some of all of their investment. There is also counterparty risk to consider here, which means investors are exposed to the creditworthiness of both the issuer and the swap counterparty. And liquidity risk can be significant here as well, while CLNs are often bespoke products and may not have an active secondary market, for example. Complexity risk is a big one as well. That means that these products can be difficult to fully understand, especially for less sophisticated investors, and you usually have to model to perform a very sophisticated modeling just to price to value these instruments. And market risk is also a factor, while changes in interest rates, for example, or credit spreads can affect the value of CLNs. So pricing CLNs, as I said before, is a very complex process, which involves several components. First, we need to consider the value of the underlying bond. And this forms the base of the CLN's value. Then we need to factor the value of the embedded CDS. For example, this is where things get trickier, but as we need to model potential default scenarios, we have to do that. Then funding costs play a role. The issuer needs to finance the purchase of the collateral. Usually, the expected recovery rate in case of default is really crucial, and this can vary significantly depending on the reference entity and the specific terms of the CLN. Then sophisticated models often used in Monte Carlo simulations are usually used to price CLNs. These models actually need to account for various scenarios and risk factors. And one insight, due to my experience, is that the complexity of these pricing models means that different issues might price similar CLNs quite differently. So this is a tricky thing, actually. This can create opportunities for savvy investors on the other hand. So the regulatory treatment of CLNs can vary depending on the jurisdiction and the specific structure of the appropriate instrument. So let's look at some key considerations. In some cases, CLNs may be treated as securities rather than derivatives, and these can have implications for how they are regulated and how and who can invest in them. There are often specific disclosure requirements for complex structured products like CLNs, and here regulators want to ensure investors understand what they are buying actually. There can be potential implications for bank capital requirements when CLNs, for example, are held as investments, and these can affect how attractive these products are for banks to issue or hold. And in my experience, for example, the regulatory landscape for CLNs is constantly evolving. It's crucial, really, for issuers and investors to stay up to date with these changes. And one interesting trend I've observed here is the increasing scrutiny of how these products are marketed, especially to non-professional investors. So, and that might be a real problem for the regulator, for any regulator. And here regulators are keen to ensure that these risks are clearly communicated. So while both CDS and CLN deal with credit risk transfer, they have some key differences. For example, funding is a major distinction. While CDS are unfunded instruments, while on the other hand, CLNs are funded instruments. This really affects how they are used and how and who uses them. Then counterparty risk profiles differ. While CDS, CDS, there is ongoing counterparty risk throughout the life of the contract. For CLNs, counterparty risk is primarily at issuance. Then regulatory treatment often differs due to the CDS being classified as derivatives and CLNs often being treated as securities. This can affect who can use these instruments and how. And CDS here tend to be more standardized, while CLNs can be highly customized. And this affects their liquidity and how they are traded. In terms of accessibility, CDS are mainly used by institutional investors, while CLNs can be more accessible to a broader range of investors as well. So the credit derivatives market has actually evolved significantly over the last years, and let's look at some key trends here. First of all, the CDS market notional amount peaked just before the 2008 financial crisis, and post-crisis we saw a significant contraction. Post-crisis reforms led to increased standardization of the CDS market, and this has had both positive and negative effects, say, on market liquidity. Then we've seen significant growth in CDS index products, and these offer more liquidity and easy access to broad credit exposure. Then there has been a big shift towards central clearing, especially for standardized CDS contracts, and this has changed the risk profile on the market. In the CLN space, we've seen continued innovation of structures to meet evolving investors' demand, for example. And one trend, for example, I find particularly interesting is the growing integration of ESG factors into credit derivatives. So as to me, we're seeing more products designed to offer exposure to sustainable or socially responsible credits. So let us consider the case study. So the 2008 default of Lehman Brothers, as you may remember, I heard about that, provides valuable insights into the credit derivatives market, actually. As you may remember, it triggered significant payouts on CDS contracts, really testing the robustness of the market. And this event highlighted the interconnectedness of financial institutions through credit derivatives. This became actually a major focus for regulators post-crisis. In general, it led to increased scrutiny and regulation of the CDS market, and many of the reforms, therefore, were discussed earlier, were direct responses to lessons learned from this event. And the Lehman Brothers default demonstrated here that the importance of understanding counterparty risk in credit derivatives, because many institutions found themselves exposed to this event in ways they didn't fully appreciate it. So credit derivatives can have significant impacts on systematic risk in financial markets because of the interconnectedness. For example, risk concentration is a major concern here for any regulator as well. Large dealers may accumulate significant exposures, potentially becoming too big to fail. And the interconnectedness created by these instruments mean that the default of a major participant can have far-reaching ripple effects. And opacity of the market can mask building risks, for example, because this was a key issue during the financial crisis. And CDS spreads can amplify market shares, potentially lending to procyclical effects. And these instruments actually allow the risk transfer outside the regulated banking sector, which can create shadow banking risks. But in my view, while credit derivatives provide valuable risk management tools, their potential to contribute to systematic risk means they require ongoing vigilance from both market participants and regulators as well. So what are the future of credit derivatives? So the credit derivatives market continues to evolve, and here are some key trends to watch. First of all, we are seeing increased standardization and a push towards more central clearing. This trend is likely to continue. Then ESG factors are becoming increasingly important in the credit risk assessment, and I expect we'll see more ESG-focused credit derivative products. Then there is potential for blockchain technology to improve transparency and settlement in the credit derivatives market. And this even could address some of the opacity concerns we discussed earlier. And we are likely to see the development of new products to address emerging risks, such as, for example, climate risk. And these could open up new ways to manage and transfer these evolving risk types. And regulatory refinements as well will continue as authorities seek to balance innovation with financial stability. So we have come to the to another question. Please take your time to answer. Select the right answer as to you and write it down to the chat. So which of the following is not a primary purpose of credit derivatives in financial markets? So please let us take a couple of minutes for that. Well, let's get back. So you have pointed out the fourth answer is right. So that's right, actually. Because while credit derivatives serve various important purposes in financial markets, so including, as we said before, risk management, yield enhancement, for example, regulatory capital management, they do not actually provide guaranteed protection against all market volatility, for sure, because credit derivatives are specifically designed to transfer credit risk, but they cannot eliminate all forms of market risk or volatility, for sure. That is why the fourth answer is right. So let's go on, and we have come up to the last topic in the current lecture, so which is devoted to the counterparty credit risk management. So counterparty credit risk management is in general the probability that a counterparty in a financial transaction will fail to fulfill their contractual obligations. So unlike traditional credit risk, counterparty risk is bilateral. That means both parties are exposed to the risk of default by the other. It's most common in the over-the-counter derivatives market, in repo transactions, in securities lending, for example, and in long-term trading contracts. The risk here can fluctuate significantly as the value of contracts changes over time with market conditions. An assessment typically includes analyzing probability of default and potential losses. Here, the key mitigation methods include netting, collateral requirements, central counterparties, counterparty limits, and credit derivatives as well. So, pre-settlement risk arises here before the settlement transfer of assets. Here, key losses actually usually relate to replacing or buying the undelivered asset from the market, and the main risk size indicator is mark-to-market or M2M, which is a valuation and its volatility. So let me give you a real world example. For example, you may know about the UBS, Union Bank of Switzerland case. So UBS was founded in 1862, and it was the Switzerland's second largest bank in 90s. But in 1997 up to 1998, UBS incurred losses of $1 to $1.5 billion on derivative instruments tied to long-term capital management, which was the very well-known investment fund being established by the one or two Nobel Prize winners. So LTCM was a hedge fund, had $125 billion in assets, but only for about $5 billion in equity. So the leverage ratio was of 28-1, actually. So when Russia defaulted in 2098, so LTCM lost for about 44% of its capital in just 1 month. So there are different parts of the counterparty risk, and one of them, as one of the majors, is settlement risk, which occurs when deliveries and settlements are not simultaneous or not on pre-delivery terms. Key risk size indicators are here the volume of delivery or payments and timing or order of settlements. So the very classic example is Herstatt Bank. The matter is that on June 26th, on 1974, German regulators revoked Herstatt's license at the end of the banking day. Due to time differences, several banks had already made payments to Herstatt in German marks, expecting dollar payments on during the next day. And however, Herstatt stopped all settlements. And this led even to what was known further as Herstatt risk, the risk of losing the full value of transaction due to the time zone differences. In contrast, when Drexel Burnham Lambert closed in 1990s, the Bank of England created a special scheme to ensure all payments were completed avoiding similar problems. So we have three main categories of counterparties who bear or gives us counterparty risk. First of all, non-bank financial institutions like funds, asset managers, and brokerage firms. They primarily engage in client trading of stocks and bonds. And banks, both international and local, they are involved actually in securities issuance, derivative transactions, funding operations, for example, interbank lending or repo, trade finance, banknote operations, and even client trading across various assets. And finally, corporate clients, countries and municipalities. They issue usually securities and engage in derivative transactions and financing backed by future goods deliveries. So let's break this down by counterparty type. First of all, non-bank financial institutions. They use derivatives for speculation and hedging positions in stocks or bonds, for example. And common instruments here include CDS, forwards, options, and structured bonds. What about banks? Now, banks use usually derivatives for speculation, hedging positions, and managing banking book risks. They use a wide range of instruments like CDS, forwards, options, interest rates, and cross-currency swaps, and commodity swaps as well, interest rate caps and floors, total return swaps, and etc. And corporate counterparties. Their main goal is really hedging various risks, like interest rates on corporate debt issuing, interest rate and cross-currency swaps, currency cash flows, for example, revenue, expenses, debt using currency options and forwards, market risks using forwards and swaps and commodities as well. So the main components of the counterparty risk compared to the credit risk itself are almost the same. For example, exposure default is the estimated amount of the counterparty's obligation at the time of default. And here, the exposure default model for derivatives may be equal to the exposure default is usually equal to the maximum of the mark-to-market value of the derivatives and zero. So plus add-on, additional value. Where mark-to-market value, the current market value of the derivative, and add-on represents the potential increase in mark-to-market in the bank's favor. For example, essentially a value at risk measure. And here, the key difference between credit risk for derivatives and traditional credit products is that the counterparty's debt can change over the time depending on market factors. Then probability of default also matters. PD shows the likelihood of counterparty defaulting on the obligations within the next year on an annual basis. And PD model here incorporates various factors like, for example, quantitative, qualitative, group, state support of the counterparty. And it may be used in the following multiple ways. For example, as an early warning signal, limit setting, economic capital calculation, pricing, risk-weighted asset calculation, and therefore. And loss given default, finally, which represent the proportion of irrecoverable losses in case of default relative to the credit exposure of the counterparty. And losses here also include costs incurred by the bank in dealing with a problematic asset. For example, the LGD model may consist of the several factors like region, country, collateral, type, size of the counterparty, type of transaction, for example, administrative costs, and the model output is bounded between 0 and 100%. So this slide illustrates a key difference between credit and derivative exposures. For example, For credit product, the risk amount is known at the time of issuance and doesn't change until repayment. While for traditional loan, the potential loss profile is flat over time. While for a derivative, in terms of the counterparty risk, the risk amount is estimated at the time of transaction and regularly modeled. And the potential loss profile can vary significantly over time, as you can see here on the graph on the left. So here we have to compare expected loss for the credit products with the credit value adjustment, which is a measure of the counterparty risk or the counterparty add-on for derivatives. The key differences are, in terms of exposure, for credit, it's nominal amount, while for derivatives, exposure default is modeled at each point of time in the future. Then, in terms of PD, it's static for credit, while it is dynamic for derivatives or market observed. Then, in terms of time structure, it is not considered for credit, while it is very crucial for derivatives. In terms of scale, it is individual for credit and portfolio-wide with netting effects for derivatives. And what are the consequences here? There is a need for diversification in credit and possibility of hedging for derivatives. So let us consider a few case studies. There was such a company, KIT Finance, in Russia. So KIT Finance Group was this is the cases of the counterparty risk realization, the systematic effects of it. So KIT Finance Group was a leading brokerage and asset management firm in Russia in 2007. And in spring of 2008, with the RTS index at 2,100 points, KIT Finance sold out options on the RTS index with a strike price of 1,600 points. So for about $500 million notional. And when the index fell to 1,300, KIT Finance's losses reached several billion rubles by September 2008. And by mid of September, due to liquidity problems and falling securities prices, the bank failed to settle several report transactions on Rostelecom shares, totaling 7.2 billion rubles. And on October 8, 2008, an agreement was signed to sell KIT Finance to a consortium of investors. And the bailout of KIT Finance costed for about 135 billion rubles to the regulator, to the Central Bank of Russia. And it was really the most expensive in the history of the Russian banking system at the time. So another example is Svyazbank. Svyazbank was an active player in the interbank lending and repo markets. And as of September 1st, 2008, Svyazbank's repo operations volume was for about 13 billion rubles, while its equity as of April 1st in 2008 was for about 20 billion rubles. The bank's financial position was affected by the repo market crisis in September 2008, similar to KIT Finance. And the bank's net loss was for about 771 million rubles in just 1 month. In October 2008, there was a significant outflow of funds for about 40% of retail deposits, 11% of corporate deposits, and 46% of corporate client accounts. And due to this massive outflow, the bank violated the instant liquidity ratio N2 3 times in October 2008. And later, Внешэкономбанk announced the acquisition of Swissbank, and this was the first time the state directly financed the rescue of the private bank from the potential bankruptcy. So this bank was acquired. Okay, and in the 1990s, actually, there were numerous cases, several hundred deals maybe, involving interest rate swaps under English law between banks and municipalities. The court ruled these deals were legal as they exceeded the municipality's authority. And existing legislation only allowed municipalities to enter transaction for hedging the cost of borrowed financing, for example. But many of these deals were speculative in nature and significantly exceeded the municipality's borrowing size. The ISDA is the provision stating that breach of representatives, including having necessary authorities to enter into the transactions, which was an event of default and couldn't be used. And this was because if there was no authority to enter into deals, one couldn't argue that ISDA was concluded and enforceable. There were substantial court cases on this issue for sure, and banks were mostly plaintiffs due to rising rates, and some municipalities agreed to return payments received under the swaps. And however, banks were forced to write off for about 600 million pounds, English pounds, either non-recoverable or as a compromise of the litigation process. And this demonstrates actually that this counterparty risk in nature is two-directional. And the UniCredit case in 2012, a dispute between Hermitage Development Company and UniCredit Bank was resolved in favor of the developer. The court recognized the plaintiff's right to unilaterally terminate the interest rate swap agreement tied to LIBOR at any time before the next payment was due. And Hermitage Development received a foreign currency loan from the bank at LIBOR plus some percent, and simultaneously entered into the interest rate swap agreement. And the client agreed to pay the bank payments accrued on the loan amount at a fixed rate, while the bank would pay at a floating rate. And the client made payments as agreed until it was discovered that the client had only used part of the opened credit limit. And the client proposed to amend the swap agreement to match the actual drawn credit amount, which was a legitimate request. To reduce the swap side, the bank asked the client to pay the fair value of the swap for the difference in nominal amount, which the client refused. And subsequently, the client stopped all payments under the swap and went to court to terminate the deal. So that is another example of the counterparty risk. And therefore, the case of the Bank of Moscow Platinum Real Estate as well. The arbitration court declared currency interest swap transactions between Platinum Real Estate and Bank of Moscow, which was announced invalid due to insufficient financial qualification of one of the parties. So in particular, Platinum Real Estate. What is the case? In March 2013, the company and the bank entered into a credit agreement with a limit of 410 million rubles. And the borrower was required to conclude currency risk hedging transactions with the bank for the entire term of the credit agreement within 30 days. And in May 2013, two currency interest swap transactions were concluded. While Platinum Real Estate was obliged to sell currency to the bank at 13% per annum rubles, while its own foreign currency obligations to the bank were 9.5% per annum in dollars and 9.25% in euros. Both parties faithfully fulfilled the terms of the transactions for a year and a half, and however, servicing these obligations became burdensome for the plaintiff due to devaluation, leading to the decision to invalidate the transaction through the court. And the court found that due to the borrower's lack of the market knowledge and experience in currency transactions, the bank applied unequal conditions. For example, inflated interest rates on the USD and Euro currency swaps, and failed to explain the risks of entering into these transactions. And the court assessed the concluded swap agreements as speculative rather than risk hedging transactions, as their entire economic result depends on the random event, namely the exchange rate on the September 30th of 2016, and the final payment day for the obligation it was due. So, and finally, a few words about the corporate losses due to counterparty risk exposure. First of all corporations claim that they enter into derivatives for hedging risks. For example, currency, interest rate, and commodity risk, price risks. For example, in 2014, in many cases, the purpose of the derivatives was to try to reduce interest expenses on ruble loans by converting them into foreign currency loans with lower interest rates through derivatives. After the dollar exchange rate doubled in 2014, corporations saw both their foreign currency debt and synthetic foreign currency debt double in ruble terms. Rosneft, for example, and Transneft transferred the most significant losses due to the dollar surge in 2014, with losses of 122 billion rubles and 76.4 billion rubles, respectively, on their derivatives position. A more comprehensive list prepared by Vedomosti newspaper, a Russian financial newspaper, was provided. And according to this list, we can see so many cases of the counterparty risk exposure and realization of the different Russian corporations. So, therefore, by performing this case, I would like to emphasize several key points. First of all, currency risk can be substantial. So the doubling of the dollar exchange rate led to massive losses, highlighting the importance of careful currency risk management. Then, hedging versus speculation. While companies claim these derivatives were for hedging, the large losses suggest that they may have been taking speculative positions or over-hedging. Then, synthetic foreign currency exposure. Companies effectively created synthetic foreign currency loans through derivatives, which amplified the exposure to currency fluctuations. And there is an importance for stress testing, therefore. These cases highlight the need for rigorous stress testing of derivative positions under extreme market scenarios. Then transparency issues. So the scale of these losses suggests that the full extent of derivative exposures may not have been clear to all stakeholders before the crisis. And finally, regulatory implications. For example, such large-scale corporate losses often lead to calls for increased regulation and oversight of derivatives market. So, and the final slide is devoted to the question. So, the question is, which of the following best describe the difference between credit risk and lending and counterparty credit risk? So, please give your answer in the chat. So let's take a couple of minutes. Okay, let's get back to the questions. So I do not see actually your answers. So are there any problems? So it's okay. Yeah. So 2. No, the truth is the correct answer is third. Why? Because the key difference highlighted in the presentation in the previous slides is that the credit risk exposure in traditional lending is known and fixed at the time of loan issuance, whereas counterparty credit risk exposure in derivative transactions can vary significantly over time due to changes in market conditions. And this dynamic nature of exposure is a fundamental characteristic of counterparty credit risk and derivatives. Therefore, the right answer is third. Yeah. Thank you very much. Okay, today we will continue on the credit risk management with a practical exercise. So just shortly I will show you how to calculate economic capital or economic expected loss or economic capital under the credit risk just manually. So therefore, according to the previous theoretical issues, I told you during the previous lecture. So therefore, here on the table, you can see three key components of the credit risk, as you can remember. It's exposure default, its probability of default, and its loss given default. So for different so-called virtual companies. So just for the purpose to calculate the expected loss due to the credit risk, so we have to just multiply these figures. Expected credit loss. Yeah, that's it. So we just multiply these figures, but please take into account that these figures are percentage. So for example, probability of default and loss given default. Therefore, you have to divide it by 100. So, and therefore, we have to multiply the absolute value of, so we have 1.5% of the default probability, and we have loss given default. So yeah, we have to divide it by 100 as well. Yeah. So we have, as expected credit loss, we have for about 0.09. So it will be for about $90,000. So this will be our possible, with the probability of default 1.5%, with the annual probability of default on the annual horizon, it will be the possible on average through the portfolio credit loss in our or the same company for about $90,000. So therefore, we can do the same for the figures left. Yeah, that's okay. So we will have, we can multiply it by 1 million, for example, just to expected credit loss on average for the whole portfolio. It will be on average about $160,000 on an annual horizon. I would stress your attention. And the last step is to calculate economic capital. So it is a very easy exercise actually, because to perform that, we have to just escalate. We have to just multiply the previously calculated figures by some kind of the plus factor or multiplier factor, which will be given as 3. So it's it's not a statistically proven figure, but it is very common to use this level of the multiplier for the confidence level of the economic capital, say 99.9%, almost 100. And to do that, we have to do the following. So we can take this, multiply it by 3, and multiply it by 1 minus probability of default. So as we can see, in absolute values, it will be for about $300,000 at economic capital. So you can see for sure that it's much bigger than expected credit loss. Why? Because expected credit loss is an average. It's average of the distribution of the credit losses. And economic capital is, in this case, a 99.9% confidence level that the possible losses for this loan, for example, to the large corporation will not exceed this figure. So there is a rather different sense of this figure. This is an average, and this is an average with this probability, yeah, and this is a figure, the highest level of the possible losses with the confidence level of 1 minus probability of default. Okay, and we can sum it up, and we will have for about $500,000. So if you assume up exposure defaulted the portfolio, so we can calculate the expected capital. So in $1 million, sorry. So it doesn't make sense. Sorry. So this is in thousand. No. Sorry. Yeah, that's it. Yes. So it's for about 3% loss of the total exposure default. Yeah, that's it. And so if we calculate the overall expected credit loss, it will be less than 1%. So I try to show you the figures just to get you aware of the difference between them, or get you understand the difference between them. That this figure is an average. It's an average expected loss, and this is the maximal expected loss with a confidence level. It's 3 times bigger than the average. Therefore, it's a very simple calculation on the credit portfolio loss. So do you have any questions on that exercise?